Since the markets are at all-time highs, let's get some perspective into the picture. As we told you before the break, Ambit Capital has introduced a SENSEX target of 36,000 by the end of FY16. So effectively, they're expecting another 25% up move in the market in the next 15 months or so. Gaurav Mehta, Vice President, Institutional Equities at Ambit Capital, joins us now to talk about that. Hi Gaurav, afternoon. It's a very good day to have you with us on the show. Just tell us about this fresh target that you've introduced and what are the key triggers that would lead the market there?
Right. So, Sonia, broadly speaking, over the last several months, we've held a FY15 and SENSEX target of closer to 30,000. And that 30,000 number was premised on about a 20x trailing PE multiple for the SENSEX. Now, historically, usually in early phases of an economic recovery, you do expect the multiples to re-rate. And 20x is broadly where we have traded in such early phases of economic recoveries historically. And that was the basis of us sort of putting out a 20x trailing multiple on the SENSEX this time around. But sitting where we are today in terms of SENSEX levels, we are already at about 20x in terms of trailing 4-quarter earnings. So from here on, we do not think that the multiple itself can re-rate very significantly. So which is why, any further earnings growth, any further SENSEX returns from here on will have to be driven by earnings growth coming through. Now, in terms of earning growth, we are expecting about a 12% growth for FY15. That puts our FY15 SENSEX EPS at about 1,500. And we think that over the next fiscal FY16 over FY15, you could grow SENSEX's earnings by another 18-19%, leaving us to about 1,790, 1,800 in terms of the SENSEX EPS. Keeping obviously the trailing SENSEX PE multiple unchanged at 20x will lead you to something like 36,000 on the SENSEX.
Gaurav, so you've also said that guessing the SENSEX is a very hazardous exercise. So just tell us what can possibly upset these projections on the downside.
Right, the first assumption that we make here is that GDP grows at 6% in FY16, putting a 3x multiplier to credit growth, which has been the historical average. You would expect credit growth to grow at about 18%. Now, if in some event that 18% credit growth does not come through, and which could either be because banks themselves aren't capitalized enough to lend, and we have all been waiting for this entire PSU bank recapitalization, and so far very little has happened on that front actually. So if that doesn't come through, then obviously that's a big risk to that credit growth number. The second key risk obviously is that the capex cycle itself fails to kick off. And so far over the last 6 months we have indeed seen a significant revival in confidence. But in terms of actual capital expenditure being put through, especially by the private sector, we haven't had any significant signs, because that also requires a lot of structural reforms to be undertaken, including reform on land and labor, apart from obviously recapitalizing the public sector banks. So if none of that happens over the next 12-15 months, then obviously that could significantly derail the 18% credit growth assumption, which in turn would mean that the SENSEX earnings multiples themselves can derate, notwithstanding the fact that the earnings growth of 18-19% that we are building might also be difficult to come through. Obviously, there are risks from global factors as well, especially this entire sort of currency devaluation war that's going on currently. So what if China decides to very meaningfully enter this currency devaluation war and depreciates its currency meaningfully? What will be India's response then in an event of such a global shock? What happens to outflows from the country? So I think there are plenty of risks out there, and which is why we make the point that it obviously is a very difficult and challenging exercise. But on balance, given the base case, we think that we are looking at the 25% return figure from the SENSEX, expecting it to move to about 36,000 by FY16 end.
Okay. Actually, when I read your report earlier in the morning, I was very interested to know if you factored in the fall that we've seen in crude prices into your 18-19% earnings growth estimate for the next year. Have you? And if yes, would you still recommend investors to invest into some of these pockets that benefit from lower crude prices, like paints, tires, OMCs, etc.?
Right, so I mean, obviously we haven't assumed that Brent at about $70 or $72 a barrel stays, a sustainable level for it to trade at over the next 15 months. So clearly, if it does stay here or falls down further, then clearly that poses a significant upside risk to our EPS number. Even in that eventuality, we do not foresee the multiple to re-rate any further, but that could obviously mean that earnings growth themselves move higher, because obviously one trigger is that raw material costs themselves move lower, but secondly that also would mean that the RBI perhaps will have more leeway to move in terms of its credit policy, to move in terms of its monetary policy, and that in turn can also kick in financial leverage for a lot of these firms. So that I mean, if it does sustain here or even move lower from here on, that obviously will provide another leg of tailwind to the earnings growth number that we are building in of 18-19%.
Okay. So you said 1790 is your SENSEX EPS estimate for next year, right? If we do see Brent average at around this $75 to $80 a barrel level, how much of an upside risk do you see to this 1790 number?
I mean, it depends on two factors. I mean, first of all, how lower does it go? And the second bit is that what is the monetary policy response as a result of this? And that monetary policy response in turn depends on a lot of other factors and not just crude oil price. So which is why, it's not a linear number that I can put to you at the moment, but, it's fair to say that you should see at least a 5% kind of a bump up to that earnings number.
Right. Let's talk about some stocks now then, Gaurav. You have some interesting mid-cap and small-cap plays to play this recovery in the market. Just take us through some of them. Two ideas in the real estate space. Is this a good time to be buying real estate stocks at all, considering there are so many other better opportunities in the market?
I mean, clearly, in terms of better opportunities, yes, there are plays like automobiles, etc., which we have been very bullish on and which we continue to stay bullish on. But talking specifically about real estate, it is a very, very stock-specific sector. So you can't, just take a macro call and buy any stock at random. So which is why, we are very selective in our stock picking from the sector, and Sobha and Oberoi are the only two stocks that we think, are at this juncture worth buying from that space. But clearly there are very many other opportunities present elsewhere, including discretionary plays like automobiles, etc., where earnings visibility as well as sort of valuation comfort means that there is still room for further upsides.
You get a SENSEX target. Do you see the broader market outperforming that, or do you see it in line or underperforming?
Right, so that's an interesting question, and it is very interesting and very critical to answer at this juncture, especially because over the last 12-15 months, a lot of these small caps and mid caps, which is essentially what makes the broader markets, have already re-rated quite a lot versus the SENSEX. So while the SENSEX multiple re-rated, multiples for these smaller and mid caps re-rated even further. So from there on, again, any valuation-driven re-rating for the broader markets versus the SENSEX looks unlikely. For that to happen, for these stocks to still continue moving higher, what you would indeed need to see is tangible signs of an economic recovery coming through, tangible signs of actual corporate performance coming through. Because historically, what happens is that in an upcycle, the underlying earnings numbers or the underlying book values or the underlying fundamentals for these small caps and mid caps disproportionately move up versus the large caps. So which is why, any valuation driven re-rating is ruled out according to us, given that they've already re-rated quite a lot over the last 12 months. But clearly earnings driven upsides could still come through, and if history is any precedent, in a cyclical recovery you should see that earnings for these stocks get a disproportionately higher uptick versus the large caps, and as a result that should continue to drive the performance for these stocks.
Okay. Given the events that have unfolded in the last 24 hours, Gaurav, what's the sense you're getting? How high is the possibility of a token rate cut from the RBI governor on the 2nd of December policy?
Clearly things have moved favorably for India on this inflation front over the last 24 hours and in fact over the last 2-3 months also. But the fact is that, we need to remember that this has been a long drawn battle against inflation that the country has been facing. It's been going on for the last 4 or 5 years. So given the intensity of the problem, what makes more sense, is cutting early or being more cautious, and we think that the governor is more likely to tilt towards the later, which is to be a bit more cautious in terms of timing. And once he does get the comfort that this battle against inflation has been won, I think he will cut decisively. He might cut by a bigger magnitude. But as far as the December policy goes, our expectation still is that it's a bit too early. I think the RBI governor will wait for more signs to see whether crude prices do stay as low as where they are today, to see whether the government is actually moving in terms of structural reform to tackle the inflation problem on a structural basis, and to see once the base effect benefit tapers off in this quarter, where does inflation flare up from January onwards. So we do not think that he will move just as yet.
All right, that's all the macro stuff. But let's talk about some money-making ideas for our viewers, Gaurav. You were telling us about the potential in sectors like auto, etc. Just line out a couple of top buys from your end, either large caps or mid caps, in sectors that look lucrative right now.
Right. So, starting from automobiles, two-wheelers obviously is a space that benefits first in a cyclical recovery, and Bajaj Auto and TVS Motors would be our top picks there. Bajaj Auto is, I think, amongst those few nifty stocks which even at these valuations is very attractive from a value proposition point of view. And the fact that a cyclical recovery would mean that the urban portfolio for the stock benefits would mean that it is very favorably placed from a cyclical standpoint as well. TVS Motors is the flip side of the story, wherein margins are still very low. There is a significant product ramp up that you've seen over the last few months, and if indeed volumes come through, then there will be a disproportionate rise in their margins as operating leverage kicks through. So TVS Motors is again a preferred bet from that space. Moving on to the MHCV space, a commercial vehicle recovery, which we've already seen signs of, would mean that Ashok Leyland is a disproportionate beneficiary. And again, that stock has re-rated already to some extent, but we still think there's plenty of juice in that name. So those would be our sort of three picks from the automobile space. What we are also very positive on is ICICI Bank and Axis Bank from the private banking space, because that obviously becomes a default play to play a recovery, especially an industrial recovery. Similarly, amongst the public sector banks which seem to be flaring up today, Bank of Baroda is the most sort of reasonable name that we find, both in terms of its asset quality merit versus decently reasonable valuations even now. I think those would be the top bets. That apart, we continue to be selectively buyers in a few pharma names. We continue to be selectively buyers in a few mid-cap IT names like Persistent Systems, etc. But those would be some of the better picks to play this recovery.
All right, Gaurav, thank you for stopping by and talking about this very aggressive target that you've laid out. I'm sure a lot of retail investors will be happy to hear it.